Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, October 30th, 2024. Hope you're having a fantastical day out there in the interwebs. It is a gloomy day here in Colorado. I know, I don't say that very often. It's cold, too. I think the high today is like 36 or 35, so it's unpleasant. The highs yesterday were like 67, so it is winter, or, well, fall here in the mountains, so it's not to be unexpected, and it's not too bad. We were supposed to get some snow, and it had a little bit of flurries. I was looking out my back windows earlier today, and that was about it. So we didn't get hardly any precipitation. I mean, if you're, I don't know, an hour or two west of here at the passes over the Rockies at 10,000 feet, they got blizzards yesterday. So it's they got a lot of snow. But anyways, well, sooner than later, we'll get it here. So anyways, but before we get into our markets for today, if you could do me a favor, give me some thumbs up. Yes, give me a thumbs up, like, share, subscribe, follow, and press the notification bell. All right, let's get into the markets for today. Dow Jones was down 0.22%, 91 points, closed at 42,141. S&P 500 down a third. 19 points, closed at 58.13. NASDAQ down 0.49%, 92 points, closed at 18,620. The VIX was up 5.22% today. It's at 2035. Canada down 0.22, Brazil down 0.07, and Mexico down 0.56. In Europe, Germany was down 1.09%, the UK down 0.73%, France down 1.1%, Netherlands down 1.49%, Spain down 0.68%, Italy down 1.21%, Switzerland down 1.11%, and Portugal down 0.73%. Russian exchanges green again today. MOEX up 0.61%, RTSI up 0.89%. And the overnight markets, the Nikkei was up 1.16%, Australia down 0.83%, New Zealand down 0.5%. In China, the Shanghai was down 0.61%, Shenzhen Component down 0.12%, China A50 down 0.93%, DJ Shanghai down 0.46%, Hang Seng down 1.55%, and the Taiwan weighted down 0.46%. Lots of red on the screens today. So, we got a gaggle of turkeys coming in up my driveway. So quick kicking those dead leaves all over my driveway. Anyways, all right. I need a camera that faces out so you can see what I'm looking at. Anyways, all right. Well, let's hop into the market recap for today. S&P 500 slips amid rising yields, easing Alphabet rally. All right. S&P 500 ended Wednesday lower as Treasury yields rose and Alphabet's strong earnings couldn't fully rally the broader tech sector. Alphabet gained 3% after reporting robust September quarterly results, supported by its AI-driven cloud growth and increased ad sales on YouTube, especially from election-related spending. This has set a positive tone for other tech giants, with Meta Platforms, Microsoft, Amazon, and Apple due to report this week. However, the tech sector felt pressure as AMD dropped 9% on weaker than expected guidance, despite beating quarterly earnings. Super Microcomputer also dragged on chip stocks, plunging over 30% after auditor EY, is that right? Auditor EY resigned over board independence and accounting concerns. The U.S. economy grew slower than anticipated in Q3, with GDP rising 2.8%. Oh my God, it didn't come in at 3% like they wanted. Crazy. Short of the forecasted 3%. ADP data showed private sector employment rose by 233,000 people, suggesting a strong job market ahead of Friday's non-farm payrolls report. These numbers are likely to influence the Fed's interest rate outlook, with a smaller 25 basis point cut expected next week. I wouldn't cut at all. I'd actually start raising rates again because I think inflation's going to get spicy again. Additionally, market volatility is anticipated with the approaching presidential election on November 5th, where Donald Trump recently gained ground over Kamala Harris in the polls. In other earnings, Humana surged over 3% after strong profits from its Medicare Advantage segment, while Kraft Heinz dropped over 3% following steeper than expected revenue fall amid weak demand. Eli Lilly fell more than 6% as higher production and acquisition costs offset demand for its weight loss drug, missing earnings forecasts. So it's kind of a mixed bag right now. So, all right, well, let's dive into the GDP numbers. Third quarter GDP. This comes to us via First Trust. Mr. Robert Stein, Deputy Chief Economist, put this together. So let's see what he had to say. The U.S. economy grew at a solid 2.8 annual rate in Q3, mainly fueled by consumer spending, which, if you've been paying attention during my meetings, that's what I've been saying. Watch consumer spending, because that is going to be the first domino to fall probably when things get nasty out there. Business investment also contributed, with equipment spending up 11.1%, largely driven by AI and chip industries. However, a significant portion of the growth came from increased government spending, and especially at the federal level, which added an outsized boost to GDP. I know I've been saying this in meetings, so not that any of my clients ever watch my daily broadcast, because shame on you. But I've been saying, hey, the GDP has looked pretty good the last quarter, and then this current quarter we just finished. But there's probably a lot of government dollars spent in there, and I'd wonder what our GDP would look like if we pulled and stripped out all the government spending out of the economy. If we just turned off that spigot, which companies would survive and do well, and then which would crater? It's kind of like when the tide goes out at the beach. Everyone who's not wearing who's skinny dipping, you can tell, because the water's gone. But anyways, where was I? Government debt. Without this government spending, GDP growth would have been 2% instead. This reliance on government spending has been ongoing, and its eventual slowdown may impact the economy negatively. Who's been saying that? This guy. Further concerns include a low personal savings rate of 4.8%, below the pre-COVID average of 7%. As consumers' COVID-era savings dwindle, they may reduce spending, potentially impacting businesses dependent on robust consumer activity. Well, I think all businesses rely on consumer activity, or else you don't have a business. The delayed effects of the Fed's tighter monetary policy could also slow economic growth in the future. Yeah, they got rates up to 5 and kept them there for a year, 5.5 and kept them there for a year. Not exactly obscene by any stretch of the imagination. All right. Inflation indicators showed modest improvement, with GDP prices up 1.8% in Q3 and 2.2% year over year, though still slightly above the Fed's 2% target. Nominal GDP, which combines real growth and inflation, rose at 4.7%, leaving the Fed some room to consider modest rate cuts. I don't see how. In labor news, the ADP report showed private payrolls grew at 233,000 in October. However, storms and strikes may limit the official non-farm payrolls report to about 101,000, with the unemployment rate holding steady at 4.1. Home prices also rose modestly, up 0.3% in August and 4.2% over the past year, driven by a national housing shortage, which suggests steady but limited gains in the year ahead. All right. Good, not great, but there's a lot of, what I call fake spending in there, government spending. And, it artificially boosts the economy, makes it look better. And in reality, in, companies and jobs that are productive for the private sector, 2%. So, all right. Last up from Zero Hedge, it's beginning to look like a debt emergency. This was written by Benjamin Picton, senior macro strategist at Rabobank. With the U.S. election approaching, financial markets are responding to potential outcomes. A Trump victory would likely mean renewed focus on fiscal expansion, tax cuts, and tariffs policies that could fuel inflation and push interest rates higher. As Trump's odds have improved, markets are adjusting, pushing the yield curve upward and signaling expectations for fewer near-term rate cuts, but higher inflation over the coming decade. Yeah, because it's the Republicans that spend too much money. It's all of them. Notably, U.S. 10-year yields are up over 55 basis points since September, impacting mortgage rates and making home purchases pricier. Meanwhile, the steepening 2s and 10s yield curves, a measure of near and long-term rates, reflect inflation expectations fueled by fiscal policy. The prospect of a Trump win while driving inflation concerns is not the sole factor. Kamala Harris's policies are expected to maintain high spending, particularly in areas like healthcare, defense, and interest payments, all contributing to the federal debt. The U.S. faces fiscal strains, and without substantial adjustments, economic analysts foresee a financial repression scenario where inflation outpaces bond yields, diminishing real returns for bondholders. In response, smart money is increasingly moving towards real assets like equities and commodities as inflation hedges evidenced by the S&P 500's 22% gain year to date. This trend also indicates a broader move towards assets expected to appreciate in an inflationary environment. Globally, rising debts and stagnant growth are making austerity and default unlikely options for government. Instead, many are likely to engage in hidden defaults by devaluing currency, shifting the economic landscape towards financial repression, where bondholders bear the cost of debt. Markets seem to be signaling a debt-driven emergency and an inflationary future where real assets may hold the most value. Probably not a bad idea. All right, well, that's everything that I had to talk about for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there, so feel free to give me a buzz. All right, well, that's everything that I had to talk about, like I said. So hope everyone out there has a wonderful evening, and I'll talk to all y'all again next time. Adios.